You're listening to Carrie Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome. This is Financial Survival Network. I'm your host, Carrie Lutz. Well, got a really good guest on for you today. And, well, where do we begin? Dan Thompson, experienced executive, as you like to say, you began your career back in the 80s, and you've learned a lot of invaluable truths. You were a stockbroker, traditional financial planner. You got fed up with all of Wall Street's puffery and words of wisdom, if you will. And here you are now. So we're thrilled to have you on. What should you be investing in these uncertain times? And what is the safest thing to do? How do you really stop your portfolio from really suffering devastating losses?
Yeah, good question. Well, good to be here. Thanks for having me. 38 years at this stuff, it's not easy. And especially as people, what happened to me is in the 90s, as my clients were getting older, and then we went through that .com boom and bust. And I just figured that, man, I got to find a better way. So one of the things that we do, we try to take it almost away from the traditional financial planning methods and use assets that produce, income, so to speak. One of the things that we're really good at is leveraging life insurance into other assets. So not just your typical, insurance. What we're trying to do is get a well-designed, high cash value type policy. But then what we do is we leverage that into things like real estate, conservation easements, carbon credits, and produce, a lot more tax advantages and income.
All right. So these are policies that don't have a large death benefit, but they have a large enough death benefit to qualify as life insurance. Do I have that correct?
Yeah, we actually try to get the least amount of death benefit that we have to stay within the IRS guidelines and to keep it tax-free.
So give us an example. Me being a senior citizen, 65 years old, what type of policy would I buy and how much would I have to put in it?
So we do two different styles, and we kind of like to blend them. We use both a whole life and an indexed universal life, but the indexed universal life has to be with a specific type of policy. But long and the short of it, you really can put in as much as you like, as much as you can. Eventually what happens to us is we max out on what the insurance companies will let us put in. So our clients are putting in 100, 250, a million, 5 million, anywhere in between, trying to get in as much into the policy as they can. And again, stay within the MEC guidelines. And then what happens is all of us at some point are going to be what the insurance companies say worth more dead than alive. And that's where we max out, to where we can't get any more death benefit. So that's going to be different for everybody. I'm 62, so us guys 62, 65, it's going to be based on our current health. It's going to be based on our income and net worth. But again, you kind of want to put in as much as they'll absolutely let you. I'm doing one right now with a guy. He's 59, so he's close to us. And we're trying to squeeze in $750,000. And then once that's in there, we'll start to leverage it into other income producing assets.
I see. And then when you talked about other income producing assets, such as, give me some examples, please.
Well, we like multifamily real estate. That's just the most stable through all kinds of environments. People need a place to live. And we like having, 1,000 or 2,000 people paying rent each month rather than, a building with 4 or 5 people in it. So we like multifamily, plus we get the depreciation. Obviously, we like to use leverage on those policies as well, on those investments as well. So we're getting a lot of depreciation, we're getting cash flow, and eventually when we'll do 5, 7, or 10 years down the road, we can actually do a little refi and pull cash out and do the whole thing over.
Rinse, repeat. So you really think real estate now, it looks like rents have kind of peaked. They're falling in certain areas, but you're convinced long term it's the place to be?
It's certainly an interesting time. There's some things happening out there that could make this a very good buying opportunity. I'll give you an example. Some of these big hedge funds who bought multifamily a few years ago, a couple things they did. They bought them with variable interest rates, thinking, interest rates at 2%, this will be awesome. We'll get cash flow. Not really anticipating what's happened to interest rates lately. So they're kind of going to be in a world of hurt as these interest rates change on them, and now their mortgages, if you will, are going to double, if not even 2.5 times. That's going to make cash flow tough. So the other thing that they did, a lot of these hedge funds, they promised a subordinated return to the investors. Now, I don't have any, there's nothing really wrong with that. It's great for the investors, but it's really not good for the partnership and the properties over time, because what'll happen is if there are situations like this where they need to cut back on distributions to cover higher interest rate mortgages, and the investors are still expecting their subordinated return, if you will, what's going to possibly happen in the next few months is a lot of these properties are going to get dumped, and they're just going to have to get out of them because the cash flow is not going to cover both the mortgage and the investor returns. So we're thinking of that's going to be a great opportunity for us to pick up some of those multifamilies or to get involved in other partnerships that are doing the same thing.
Okay, so you're going to pick these up from institutional investors who basically they've outlived their usefulness, particularly hedge funds. Do I have that right?
Don't just survive, thrive. The Financial Survival Network.
Torque Resources is an exploration company establishing a portfolio of premier copper-gold early-stage projects in Chile. Torque's management and technical teams have a strong track record of raising capital, discovery, and monetization of exploration successes. The company's Margarita Copper-Gold project is located within the prolific coastal Cordillera Belt in Chile, which hosts some of the world's largest and most profitable copper mines. The Margarita project possesses excellent discovery potential for a major copper discovery due to the strength of the alteration system, large-scale magnetic targets, and the presence of copper oxide mineralization. Drilling is anticipated to begin in Q3 of this year. Torque trades in Canada under TORQ and on the OTC under TRBMF. To learn more, go to torqueresources.com. That's torqueresources.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
Yep, that's about right.
All right. Well, that's an interesting take on things. Right now, the cap rates are so low on these multifamilies. It's unless you got a value add or some means of forced appreciation, it's very difficult now.
No, you're exactly right. Those things obviously have to be, calculated and accounted for, but we could probably, we'll most likely see some heavily discounted properties. Again, anytime there's a down to the market, it's always an opportunity for others to get involved. So if we can get into these things, get a decent cash flow, and again, the hard part is right now, people still need to rent. I mean, renters are becoming more prevalent because they can't buy the house that they wanted to buy because mortgage rates are too high. So it's just kind of this cascading event. And there's a lot of, younger millennials just not all that interested in buying houses. They like the mobility. And so renting is kind of the, their first and foremost choice. But yeah, no, you're exactly right. There's certain things that have got to be, accounted for. But the reality is when you look out 5, 7, 10, 20 years from now, it's going to be a really good place to be.
All right. And you got inflation. So what's your take on inflation? And do you think you're covered by real estate?
Well, you never know, because obviously if inflation just gets out of control, I don't know if there's any place that's going to handle, 15, 20, 25% inflation like we saw in the 80s. Hopefully, if that does occur, it's short-lived. But if you can get into properties where at least that a 90% occupancy will cover your mortgage is in a fixed rate, you don't have to worry about the variable rates going up on you. If you can get into those kinds of properties at a good, at this particular point in time, even if inflation and interest rates continue to go against us, there's a strong possibility that we stay locked and loaded and can keep our head above water during these times. Now, the other side to that is this. You don't have to take those kind of risks. That's a nice thing about having your money in a safe location with a guaranteed, floor in a strong life insurance company, because you're going to get a decent rate of return. It's not going to be anything stellar, but it's going to keep your money safe and protected away from, a lot of the risk that's out there. So it's not like you have to jump quickly, and we can bide our time. And believe me, one of the things we're going to be very careful of is making sure we're getting in the right properties at the right time. So we're not in a hurry. It's just that's the ultimate strategy, is to get the $1 doing the work of $2, $3, $4 by leveraging through the life insurance policy.
All right. Well, that sounds like an interesting take. Tax benefits here. You borrow from your policy tax-free. Is the policy going to own these properties, or you're going to own them? And then how does this work?
Yeah, the policy is just a location for your capital, but then you'll actually take a loan against the policy through either an outside line of credit or just directly from the insurance company. That's the money you'll use. And then how you buy the real estate, you might do it in an LLC or privately or with other partners. That's totally separate. The life insurance company is life insurance policy is always going to be owned by you.
Right. Okay. Hey, so let's see. The website here, Dan, where we find you is wisemoneytools.com.
Exactly. That's the place. We also have a pretty significant YouTube channel of the same name, Wise Money Tools. And I think we got 500 plus videos out there now. So.
Okay. Excellent. We'll have a link to it in the show notes on Financial Survival Network that'll accompany this interview. And while you're there, sign up for your free newsletter. If you got a question for Dan or myself, shoot us an email, kl@kerrylutz.com. Thanks so much, Dan, and we'll talk to you again soon.
Absolutely. Thanks, Kerry. Good to meet you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.